It's known as Woodstock for Capitalists, hosted by the Oracle of Omaha. Jack, do I have any other business cliches left?
No.
Okay. Warren Buffett will be center stage next weekend at the annual meeting, and it's the first time his friend and business partner Charlie Munger won't be at his side. Investors are watching to see how the succession at Berkshire might play out when the 93-year-old is no longer running the company. It's the Barron's cover story this week, written by our resident Buffettologist, Andrew Barry. So, Andrew, this is like your Super Bowl. You will be watching very carefully. What are you looking for at the annual meeting?
Well, you know, Buffett is turning 94 in August, so people will be looking to see how he looks, how he sounds. Is he as sharp as he was last year when he was on top of all things Berkshire and the economy and financial markets? It's a marathon. He'll be talking for 5 hours, which you could test the stamina of a much younger man. He doesn't screen the questions, and he wants tough questions from the shareholders.
So he's been at the helm for 58 years, far longer than any other CEO in the S&P 500. One of these days, he won't be there. What's the succession plan?
Well, I mean, he'll have his successor up on the dais with him, his likely successor, Greg Abel, who's 61. Also up there will be Ajay Jain, who's an insurance maven who heads the insurance businesses at Berkshire. Other people who will be part of the succession plan include his son Howard, who's not well known, who's 69. He'll probably be the non-executive chairman in the post-Buffett era. Then you have the two stock pickers, Todd Combs and Ted Wexler, who now run about 10% of Berkshire's $360 billion equity portfolio. They could run the entire portfolio when Buffett is gone.
So one question is hanging over Berkshire, really, is will that portfolio remain intact? Will Berkshire get broken up? What do you think would be the right thing to do, and what do you think will happen?
Well, Berkshire is an anomaly. It's a gigantic conglomerate, a time when conglomerates are out of favor on Wall Street. GE just broke up. United Technologies broken up. Big companies like J&J and Pfizer have shed divisions. Buffett wants to keep it together. He thinks there's a benefit to being a giant company, given the earnings power the company has and some other tax benefits. But there could be pressure on the company to break up from activist investors or others in the post-Buffett era.
How has Warren Buffett stayed, how's his personal brand stayed so strong over the years? He's performed in line with the market for decades. He's around 15 years older than two guys running for president. We talk about them as being way too old for the job. My math says that he's somewhere between Dolly Parton and Jesus in terms of popularity. I'm trying to be more popular, make some friends maybe. How does he do it?
Well, you know, he's done it in kind of his unique way. I mean, he's basically, he said that, you know, it takes 20 years to build a reputation and 5 minutes to lose it. He's built his over 60 years. Integrity and just building this business steadily over that period of time to where it's earning $40 billion now this year. And I think he's done it the right way.
Now, Andrew, you've been looking at Berkshire for such a long time and over a long time horizon, but is it a buy today? Do you still think it's a good play for investors?
Well, the stock is trading, I think, pretty reasonably. The A share is around $600,000. The share is about 1.5 times book value, which is slightly above the 5-year average. And it's trading for about 22 or 21 times this year's earnings. But given the defensive characteristics and given the growth characteristics and the fact that you could see reasonable growth in book value over time, I think the stock is pretty reasonably priced here.
I love those images of him throwing the newspapers. He was a newspaper delivery boy, I guess, around World War II. One thing about that portfolio is it's almost really more like a mutual fund than a stock. How should investors think about it?
Well, some people think of Berkshire itself as almost like a mutual fund. Given its broad exposure to the U.S. economy, you're getting one of the greatest investors of all time running your money. He earns just $100,000 a year. It's effectively almost a low-fee mutual fund. And there could be a kicker if there's ever a breakup, because many people think that the sum of the parts, meaning the value of the businesses inside Berkshire, including Burlington Northern, big utility business, a huge insurance operation, are worth more than where the stock is currently trading.
Critique that portfolio. I want to hear about Berkshire Barry way. Tell me, what are like your two favorites that the company owns and maybe two you'd get rid of?
Well, basically, it's got a big, some of the biggest holdings are Apple, American Express, Bank of America, Chevron. I'm partial to Chevron. I like the energy industry right now. Amex has had a big run, and it's up about 30–40% this year, and it's a little bit rich. I might avoid that one. And I'd say Apple's looking interesting here. It's been a big laggard among the big tech stocks. and it's trading for about 25 times this year's earnings. You get any good news on AI, and Apple could do better this year.
What about that Geico Insurance? Is that Gecko still pulling his weight? I see an emu on the TV. I see all kinds of competition.
Well, that's actually an interesting issue. Geico, it used to be number 2 in the industry, has lost ground at Progressive. It's underinvested in technology. And Todd Combs, who runs the part of the equity portfolio, has been heading Geico and trying to turn it around. It's been a heavy lift. They've been losing market share pretty steadily to Progressive.
They need a new animal.
Yeah.
All righty. Thanks, Andrew.
Yeah.
Great to have your insights.